Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, cut your taxes, and have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my esteemed co-host, Matt Nadeau here.
Hey, everybody.
Matt, we had such a good event last night, by the way, for our clients.
Oh, my gosh. It was fantastic. I mean, for our clients out there who attended, I'm sure you loved it. We had great feedback. We invited our clients and their beneficiaries to come have a nice dinner, learn
Wine.
all about stuff. And some wine.
Country
So
Club.
beautiful.
So we even live streamed it for our clients' heirs that were out of state. And it was a lot about all the important things you need to be aware of when it comes to estate planning, when one parent passes and then you got to take over as the next generation, all the taxation. It was wonderful. We got a lot of good feedback on it. And that's what happens when you're one of our clients, by the way, if you choose to work with us. We have these fun events, but we also make sure that all of the important areas in your life are taken care of regarding
That's
your
right.
finances. But back to here now. We're both founding partners and wealth managers at Barzideh Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington. And we are fiduciaries. And as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days.
And of course, again, saying hi to our clients and also our faithful listeners who are listening today. Clients, I hope you are able to make it. If not, reach out to us. We'll give you a link to watch that wonderful workshop we did last night. And also thank you again for the trust you place in us. We love every one of you. So today, let's talk about a few things. One, I know last week, end of day Friday, like we had already recorded our show, but the Supreme Court had a ruling on tariffs. And we want to talk about what does that mean? What does it mean for the markets? And kind of along those same lines, there is a gauge that we're watching that could potentially be signaling some bad signs out there. It's one of the most important ETFs in the market. We're going to talk about what it is and why it's important. And then, of course, later in the show, for one of our big important financial planning topics and estate planning, we want to talk about something called a Qualified Personal Residence Trust, a QPERT, and how that could potentially lower your taxes.
You don't want to miss that. And most of you listen to us on the radio, but just so you know, the show that you're listening to, we actually record it as well, and it's on our YouTube channel. So if you go to moneyhourradio.com, you can subscribe, like our YouTube channel. We already have over 10,000 subscribers and growing fast. Also, please sign up for our weekly economic commentary called the 5-Minute Market Brief. It's informative, succinct, easy to read. You get a really good idea of what we're seeing and what we're doing, and that's also on beinwealth.com. All right, Matt, let's get into it.
Yeah. So let's talk about this Supreme Court tariff decision. Last week, of course, the Supreme Court really did meet expectations from the market, and they invalidated the tariff imposed under IEEPA, which is practically all the tariffs announced by the administration since Trump took office. Now, what does it mean? To the markets, actually, probably not a lot. Because, it's like, we're all worried about nothing. And realistically, the markets had already digested this. First, it was widely expected. We can see what the prediction markets had, where it was a probability of 80% or higher to happen. So everything had already been priced in. We were able to adjust for it. And second, really the tariff burden had been consistently moving lower ever since Liberation Day last April. And investors really have started to ignore these tariff headlines since then.
And then third, tariffs are not going away. So President Trump has already announced 15% global tariffs under Section 232, and those tariffs can stay in place for 150 days, but they have to be renewed continuously, and they will be challenged legally, of course. And then additionally, the administration is launching various investigations that could lead to the reimposition on tariffs, but it'll take time. So there's going to be different ways about it.
Yeah, it's like wait and see. We don't think much is going to happen.
So far, as evidenced by the market this week, it's been a kind of a nothing burger. Now, here's what is a big deal. So there's bad signs from one of the most important ETFs in the market right now. So if you analyze the market under the hood, which is a big part of what we do, you notice something very important, ominous happening, and we've been bringing it up over the last few weeks. In literally just a few weeks' time, the AI phenomenon went from a rising tide raises all boats to a tsunami that could sink all the ships. I mean, I don't know if I've ever witnessed such a massive shift in just such a short amount of time.
I mean, right? Life moves fast, right, Ben?
I mean, it went from chic to geek in literally in just a couple weeks. And what's
Uh,
interesting is right now, I don't know if I've ever seen something like this. Cyclical sectors and defensive sectors are going up at the same time. They're usually opposite. We got tech making money, S&P making money, as long as the companies don't have anything to do with AI. So literally, the only thing not going up is AI.
I got to be honest. I've seen something like this, Ben, and we just got to go back to the beginning of 2021.
Good
2020
point.
was so
You're right.
crazy. Tech exploded the last half. Took a breather the first quarter of 2021, and then it was off to the races again.
But who had that on their bingo card coming into 2026, right?
No, I know it's crazy. And we've had to explain to you over and over again how these AI headlines have now actually started to become a market negative. And it's really unfolding that there's this concern that there is too much investing, massive AI investing for companies, and they're not generating profits to show for all the investing so far. And it might get worse. So the initial thought around AI is it's going to be a massive productivity boost to basically all the different market sectors. But investors are still saying now, it's gone too far. This AI will boost productivity so much, not only could it potentially reduce headcount and increase efficiency, but some of these companies may literally get eliminated completely because they're being taken over by AI. Basically, it could start putting not only people out of jobs, but businesses completely out at that point.
It's just crazy. So basically, the company that designed the AI might get put out of business because of the AI. It's just nuts.
Thank you.
So therefore, SaaS, which stands for Software as Service stocks, have become a ground zero for concerns that AI will potentially destroy earnings power for large market sectors. And here's how to follow it. So we're going to bring it to you. In our view, the iShares software ETF with the ticker IGV, that index is now the best barometer of market negativity regarding AI anxiety. And you better believe we were watching that closely. And it is disconcerting that IGV collapsed below the February 5th low earlier this week. And in fact, it is now at the same value it was at the bottom of the March-April tariff tantrum that happened last year. Basically, it has given back almost a year's worth of gains. It's down about 50% from its high. So going forward, selection and timing have become a lot more critical in our view. That's why we analyze these trends so closely, because it affects how we invest. We don't just talk about it to sound smart and impress anybody.
Yeah, it's not like we watch it every day but do nothing about it. We watch it every day so we can do something about it. And it's in our advance and protect models that I know you've heard about as we've talked on the air. They are models that are actively managed, and we do this actively for our clients where we will adjust allocations and we'll move to areas of the market that have momentum and strength and avoid areas of continued weakness. And of course, trends change, so does our allocations. And I really wonder, does your advisor do something like that? I mean, do they just use the same plan no matter what's happening, bull market, bear market? And of course, when the market's in a good uptrend, like it has been for a while, we haven't taken our foot off the gas. In fact, in some of our more growth oriented models, we're pedal to the metal, 100% in equity. We have been going back for months. It was a great year last year making money for our clients. We're off to a great year in 2026. But the key thing is actively monitoring these investment positions. And if you start seeing the overall market conditions deteriorate, then we will get defensive. We'll start actually selling things. We'll get out of the market. We'll start going heavier into bonds or cash, and we'll wait for things to improve. And literally, if things get bad enough, we will get 100% out of the market. Again, if conditions warrant it, that's what we'll do.
And the reason we do that is our philosophy. We do not believe in riding potential market crashes all the way down to the bottom and watching money dissipate. When you're in retirement, it's paramount to have a disciplined sell strategy to exit the market and protect your money if the risk of a crash gets too high. And you know what's the best time to have one? It's before you need it, while things are still fine in the market, not after a crash when it's too late. So, do you have a defensive plan to protect your money from a potential market crash? We feel you should. So if our investment philosophy resonates with you and you're looking to have your money managed like that, then reach out to us, please, and schedule a complimentary consultation. We'll go over your financial situation and your goals. If we can help you, that's great. If we can't, that's okay too. We'll still part as friends. And by the way, if you like buy and hold, if you're buy and hold Bob and you like your money managed like that, guess what? We can actually do that for you. It's really easy for us. Okay. We'll probably be making fun of you behind your back.
Yeah, come on, man.
No, I'm joking. So, no, reach out to us, please. The phone number is 847-780-2980, or you can reach us online at bnwealth.com. So don't go away, because as soon as we come back, we're going to talk about qualified personal residence trust and how it may lower your taxes.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. I'm, of course, one of your co-hosts, Matt Nadeau. I've got with me my esteemed co-host and sidekick, Ben Barzideh.
Hello, everyone.
And we're founding partners and wealth managers at Barzideh and Nadeau Wealth Management. It's a comprehensive financial planning firm. We're located locally in Barrington. We're here to serve the greater Chicagoland area. And as we've talked about in the past, we do value giving back and trying to make our community a better place. And that's why we have a charitable arm of our company. It's called BN Giving. And it's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a giver to a qualified 501c3 charity, just let us know. Each year, we will match your donation up to 10% of the management fee that you pay us. And as our firm grows, so does the collective positive impact that we can have. It's such a neat concept. It's unique to our firm. We're very proud of it. And by the way, if you're not a regular giver, that's okay too. Most people aren't. We would, of course, still be honored to work with you. But to explore how you can join our BN Giving community by becoming a client, of course, please reach out to us online at bnwealth.com or call our office at 847-780-2980. All right, let's get into talking about qualified personal residence trusts, or QPERT to be short.
Yeah. And really the key thing, the only reason we bring these things up is to maybe help you lower your taxes. And, many of our listening audience will test. This is a show, it's kind of at the intersection of financial planning meets really bad dad jokes. I guess I'm not too proud or embarrassed to admit that. We're both of that age. And
Yeah.
Today's episode is all about something that sounds like a secret government agency, but it's not. It's actually a powerful estate planning tool. It's the Qualified Personal Resident Trust, or QPERT. And here's why we like it.
So a QPERT, what it is an advanced estate planning strategy that allows a homeowner to transfer a primary or a vacation home to heirs, but at a reduced gift tax value, while continuing to live in a home for a specified period of time. And QPERTs are commonly used by high net worth individuals seeking to minimize estate death taxes and also preserve family wealth across generations. And by the way, for all you nerds out there, for all the geeks, it's found under Internal Revenue Code section 2702. And
it's like, how many sections do they have? Like 2702-37.
A million trillion.
Yeah.
All right. So basically, it's designed to let you transfer your home, yes, your actual house, to your heirs at a reduced gift tax cost while you continue to live in it for a certain number of years. So it's kind of like saying, hey, this house will be yours someday, kids, but I'm still picking the paint colors.
Yeah. So here's how it works. So you're the homeowner, right? And you go and you create an irrevocable trust. And now you're going to transfer that home, your primary residence or a vacation home. Okay. You're transferring it in there. And you set up a term. So you can pick 10, 15, 20 years, something like that. During that time, you have the right you maintain that right to live in the house rent-free. At the end of that term, the house officially passes to your beneficiaries, usually like your children, either outright or again in a further trust at that point. So now here's where the magic happens. When you transfer that home into a QPERT, the IRS says, okay, so you're giving away the house, but you're keeping the right to live in it for a while. So they'll actually reduce the taxable value of the gift based on how long you're keeping that right. So the translation in easy terms, the longer the time you stay there, the term, the lower the value actually is of the taxable gift today. So it's like the IRS, you're kind of telling the IRS, I'm going to give it away, but not really giving it away yet. And the IRS says, all right, cool, whatever. We're going to just figure out some math about it just to keep us honest.
Yeah, they're like, you better believe we're going to be doing some math. All
They-
right.
I mean,
Yeah.
they'll get to it eventually.
We're watching you. All right, so let's talk about the benefits. First big benefit is estate tax reduction. If the home appreciates significantly after you transfer it to this QPERT trust, all of the future appreciation happens outside of your estate. That's a big deal. So, for example, say your $2 million beach house turns into $4 million beach house. That extra $2 million will avoid estate taxes or death taxes, as they're often called as well. So, second, you freeze the home's value for transfer tax purposes at today's value, but then discounted. And that's especially powerful in a rising real estate market. And then third, after your term ends, if you want to continue living in the home, you can pay fair market value rent to your kids. And that might sound awkward. You're like, what? Pay rent? Hey, sweetie, here's this month's rent. But here's why you do that. It's actually another estate planning tool that's a benefit for you. The rent payments further reduce your taxable estate without being considered gifts.
I mean, it sounds all like beautiful, but we got to pump the brakes and sometimes be the bearer of some bad news because there are some pitfalls. It's not always sunshine and rainbows or, all that good stuff. So pitfall number one, this is irrevocable. Once you do it, it's done. There's no going back. It's like a bad tattoo back in your spring break days, huh, Ben? So once you put your house into the trust, you can't just wake up one day and say, I want my house back. You also can't say, you know what, I've decided to sell it, move to the villages in Florida, well, you can sell, but there are some really strict rules about reinvesting the proceeds into another residence within certain timeframes. It's really not designed to be that flexible. And pitfall number two is also if the homeowner dies before the end of the trust term, then this whole strategy basically evaporates. The house gets pulled back into your estate as if you never did the trust. So you got to be really careful choosing the term. That's a balancing act. If you do a longer term, you're getting a much better tax discount, but there's a higher risk you won't outlive it. So you really don't want to die if you have one of these. So it's like cut back the skydiving. Don't go doing some crazy adventure. Just be a little careful.
So pitfall number three, there is no step up in cost basis. So what we mean by that is when your heirs inherit property through a QPERT, this trust, they typically receive the original cost basis. That means what you put in, not what you put in plus the gains. That means if they sell the home, they could face significant capital gains taxes on the appreciation. Now compare that to inheriting property outright at death, which they usually receive a step up in basis to the fair market value, basically wiping out the taxes on the gains. So there's a balance, there's a trade-off. So in other words, you may save estate tax, but could create income tax consequences later. So who is a QPERT good for? Qualified personal residence trust. Here's the conditions. Generally, high net worth individuals looking to reduce their taxes. So people who have a valuable residence, expect the property to appreciate, are comfortable giving up ownership, and are reasonably confident that they'll outlive the term of the trust.
Yeah. So let's just, a couple final thoughts. This is definitely a more elegant strategy. And when used correctly, you can see some big benefits, but definitely not something in a do-it-yourself territory. This is not something that you want to do a YouTube university on. This is definitely in the call your estate planning attorney, your tax advisor. You want to get all the professionals involved if you're going to need this. And, we always joke, don't bring your cousin in who took an accounting class in '04. And it's like, hey, I've seen a lawyer show. I know how this works. And then remember, when we talk about estate planning, we're not trying to be morbid. It's just being organized, thoughtful, and a little controlling beyond the grave. But, it's okay to be controlling later. Nobody's perfect, right?
And you know what? This is important if you live in a state that has death taxes, because on a federal level, married couple, you need to have over $30 million net worth before you get into realm of paying death taxes if you give your money to your kids, or, if they get it on the top side, or if you leave it when you pass. But in Illinois, for instance, death taxes start at $4 million.
Right.
So all of a sudden, it's a lot easier to get into the realm where you might have to pay death taxes. So then all of a sudden, the strategies that can reduce that value become instrumental and could save your heirs a lot of taxes. So as with any financial planning, investing, tax, estate planning, it's critical to work with qualified professionals who understand these concepts, can custom tailor them to a unique situation. Usually a good financial planner like us, we're like the quarterback of the plan, and we help coordinate it with you and your other professionals. And if you are in need of a knowledgeable financial planner, someone who's ethical, someone who puts your interests first, we would be honored if you give us an opportunity to talk with you. If our investment philosophy, if our financial planning philosophy, if those things resonate with you, then please reach out to us and schedule a complimentary consultation. We'll go over your current financial plan and your goals. We can also provide what's called a financial checkup, where we analyze your whole entire financial plan. If it looks good, we'll let you know. And if it's not, we'll let you know as well. And at least you can leave with some peace of mind. So if that's something you're looking to do, please give us a call, 847-780-2980. You can also go online at bnwealth.com. And then, Matt, do you want to talk about how they can subscribe, like and subscribe?
Yeah, and I just want to throw one more thing out there. I know we talked about a strategy today that's for super high net worth people, but if you're a retiree or retired and you don't have a QPERT in your need, we work with most people who don't need those QPERTs. So please reach out. Also, subscribe to our weekly economic newsletter. It's called the 5-Minute Market Brief. We're going to give you great information about the market, the economy, all that great stuff. You can sign up online at bnwealth.com. Please subscribe to our YouTube channel. It helps us out. We're over 10,000 subscribers now. Smash that button, as they'd say. Anyway, go to moneyhourradio.com to do that. We're out of time. God bless you, and we'll see you all next week.
Bye, everyone.